this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a new issue summary on Friday, May 17, 2024. As I state in the cover page article in the new issue of Personal Finance that was published on the website today, conflicting financial data regarding inflation and economic growth puts the Fed on the horns of a dilemma. Inflation rose modestly in March, making it difficult for the Fed to justify cutting interest rates. At the same time, the Fed risks triggering a recession if it raises rates in the face of a slowing economy. And the graphic in this article shows the personal consumption expenditures index for the past 4 months. And you can see in December it was growing at an annual rate at or an annualized trailing 12-month rate of 2.6%. Then dropped down in January and February, but rose in March above not only where it was in January and February, but above where it was in December. So that's disconcerting. And the Fed puts more emphasis on PCE than it does the consumer price index. So that was one data point that Wall Street really did not want to see. That's why my page 2 article addresses taking the stag out of inflation. Rising inflation and a slowing economy is sometimes referred to as stagflation, a severe bout of which this country endured during the late 1970s and the early 1980s. It is the least desirable of all outcomes since it forces companies to lay off workers at the same time the cost of living is going up. Now, as I mentioned in this article, I graduated from college in 1981 when both the unemployment rate and inflation were both above 10%. It was hard to find a job. Companies were laying off, experienced workers who did nothing wrong. The companies just had, financial issues. So, somebody straight out of college with no experience was not going to get hired when companies were laying off good people. So that was tough times, and we don't want to see a repeat of that, which is why the Fed is working so vigorously to get inflation down to the 2% target level. Now, some businesses are more recession resistant than others, including infrastructure consulting firm AECOM. On page 4, in the article AECOM's Stock Builds a Solid Future, I discuss AECOM's most recent quarterly report and why I believe the company can continue to grow revenue and earnings even if the economy slips into recession later this year. And for that reason, I've raised our buy limit for AECOM to $110. And I just want to show you, here's the graphic in this article is AECOM's backlog over the past 2 years. And you can see it's increased by 15%. So not only is AECOM doing a lot of business now, but it has even more business to do and lined up and ready to go over the next couple of years. So this is a company that even if the economy slows down and consumers start spending less and so on, they've got enough backlogs here to keep them busy. So good company to own during uncertain economic times. Now further below, and in the following page on the issue, I explain why I've reinstated electric vehicle manufacturer Tesla to a buy with a limit price of $220. Recently, Tesla founder and CEO Elon Musk traveled to China to negotiate a deal that allows the company to sell its full self-driving technology in that country. Now, that agreement requires Tesla to use street mapping software from Baidu, a Chinese company that needs a boost in sales that only Tesla can provide. And in here, the graphic, I show you Baidu's stock chart over the past 4 years. And of course, during COVID, a lot of weird things happened with some stocks, including electric vehicle stocks. But really, if you just kind of take that out of the picture, this is a stock that's been on a slow, steady decline over the past, say, 3 years. And Tesla may be their salvation. So the Chinese government is basically stepping in and throwing a lifeline to Baidu by giving Tesla permission to use its full self-driving software in that country. And there's been some controversies in this country because people have used that software and had some accidents, and now regulators are starting to think twice about just to what extent they should be allowing automobile manufacturers to sell that technology here in the United States. So China's a huge market. Even if Tesla loses some sales here, probably more than make up for that in China. Now, another recession-resistant industry is defense contracting, which has seen its fortune rise due to escalating conflicts in Ukraine and the Middle East. And as John Persina states on page 6, war is bigger business than ever and is the reason why he recommends the SPDR S&P Aerospace and Defense ETF is a play on the entire sector. So here's that article and some interesting graphic there to take a look at. Now on page 8, I explain why institutional money manager BlackRock is getting back to basics. With the world on fire and the economy on shaky ground, BlackRock is emphasizing financial performance over the environmental, social, and governance movement that it spearheaded a few years ago. I'm not ready to raise my buy limit for BlackRock just yet, but I think it is worth owning if you can get it for less than our current limit price of $780. And you can see BlackRock's the biggest, basically mutual fund manager in the world, and a lot of these are exchange traded index funds, but pretty even mixed here. 41% ETFs, 31% institutional, and that could be pension funds or other type of institutional accounts, and 28% retail. And retail is people like you and me who just own these funds directly. So anyway, again, not raising the buy limit on it, but if you can get it for under 780, I think it's worth owning. Now further down, I am raising our buy limit for global banking behemoth Citigroup to $72 after the company released its first quarter results that provide hints to its future. No longer trying to be all things to all people, Citigroup is narrowing its focus to its most profitable business units. Although that is not exactly a novel idea, it is a new approach for this bank, and one that Wall Street has been waiting to see for a long time. You can see here in the stock chart that Wall Street likes what it sees, and it's rewarded Citigroup with basically a 50% bump in its share price over the past 6 months. Now, according to Dr. Stephen Lieb, it is time to rethink commodity cycles for reasons explained in this article on page 11. Dr. Lieb has written several books on this subject, and his past predictions have proved to be prescient, so we should all pay heed to his belief that the long-term cyclicality of commodities is a thing of the past. And Dr. Lieb truly is an expert on the subject, and I suggest you take a look at that article. And then finally on page 12, we close out this issue with Robert Rapier explaining what he believes is the best way of navigating mortgage options. That's a hot topic these days with mortgage rates higher than they've been in a long time. So that's the issue. Going forward, on this Friday of each month that we publish the new issue of Personal Finance, instead of doing my usual market recap, I'm going to summarize the issue because I just think it's too much of a data dump to throw the issue at you along with me looking at a bunch of different graphs and charts of new material. So instead, I'd like to hear your feedback. If you like this format, if you'd rather I just go back to summarizing the market every week. But in any event, the new issue is out. It's on the PF site, and it's there for when you have time to take a look at it. So I'll talk to you next week, and look forward to talking to you then. Bye.